The just exchange or maintain the urban investment bond belief. Urban investment bonds refer to corporate bonds and medium-term note publicly issued by urban investment enterprises. According to the new budget law and the No. 43 document, it is clear that urban investment NDS are decoupled from local government credit. The positioning of urban investment companies has shifted from local government investment and financing institutions to market-oriented operating entities, and local governments are no longer providing support for urban investment bonds. But in reality, the market still regards urban investment bonds as high credit grade bonds endorsed by local governments. Therefore, urban investment companies are usually investment and financing institutions under local governments, making it difficult to become completely independent and purely market-oriented enterprises unrelated to the government. The debt of urban investment mainly includes two methods: borrowing from banks and issuing bonds for financing. The former method was the main method, but the latter method of debt financing is also not small in scale. By the end of 2022, the balance is estimated to be over 13 trillion yuan. Overall, since 2011, the national urban investment interest-bearing debt has expanded rapidly, with an annual growth rate of over 10%. By the end of 2022, the national urban investment interest-bearing debt was 54.1 trillion yuan, an increase of more than 7 times compared to 6.4 trillion yuan in 2011. Therefore, urban investment platforms have actually become the main manifestation of local debt, with the scale significantly exceeding the sum of general and special bonds of local governments. In the urban investment platform, the bond balance of the platform is currently about 13.8 trillion yuan, and there have been no default cases so far, indicating that urban investment bonds are still high-grade credit bonds endorsed by local governments. However, non-standard defaults on urban investment platforms often occur, and there are also many cases of bank loan extensions and adjustments to loan repayment methods. The current market is generally concerned about the growth of local government debt and the decline or even negative growth of fiscal revenue growth, especially for provinces in the Northeast and Midwest with weak financial resources. The yield of urban investment bonds is generally higher than that of developed provinces and cities in the East. In 2022, the coverage of government debt interest on land transfer fees in 13 provinces was less than 100%, only 5 in 2021. And after deducting urban investment and land acquisition, the situation of shortage is even more apparent. After the default of Yongmai bond in Henan, it has had a negative impact on the credit bond market in Henan province and even the whole country, exacerbating the phenomenon of credit stratification and marginalizing some economically weak regions. For example, financing costs in Qinghai, Yunnan, and Zhejiang have continued to rise in recent years. Financing costs in Heilongjiang and Guizhou increased significantly from 2017 to 2019. Although financing costs have decreased since 2020, the overall decrease is smaller compared to the national average. Since 2020, the weighted average coupon rate of urban investment bonds in Liaoning, Guangxi, Jilin, Chongqing, Shaanxi, Ningxia and Gansu has declined significantly less than that in the whole country. Against the backdrop of a slower than expected economic recovery, investors' risk appetite has significantly decreased. Therefore, local governments should ensure the timely repayment of urban investment bonds. Because default not only fails to solve the debt problem, but also worsens the regional credit environment, leading to difficulties and high financing costs for local state-owned enterprises. From the perspective of future regional economic development, government departments still need to continue borrowing to achieve stable economic growth, maintain government credit, and cannot easily default. Therefore, there is an urgent need to enhance the confidence of urban investment creditors. Firstly, it is necessary to ensure that urban investment bonds do not default, which means that urban investment companies can have low-cost borrowing and repayment capabilities. The central government's proposal of whoever has their own children, who has their own arms means that local bonds are not guaranteed, but it is recommended to provide some bottom-up support to provinces in need. That is, to vigorously support local governments in transforming bonds in policies, such as helping local governments such as urban investment companies borrowing new and repaying old ones to reduce debt costs and extend debt maturities. Non-bond debt extension, such as Tswanidaokia, practice bank loan extension, reduce the cost of debt through low-interest funds from policy bank or commercial banks, making it easier for debt to roll over. In addition, we also hope that the central government can provide policy support on whether local governments can repay debts by selling state-owned assets. Because on March 1 this year, the State-Owned Assets Supervision and Administration Commission said in its reply to the proposal No. 503 of the 5th session of the 13th National Committee of the CPPCC that it would timely introduce system regulations and operating rules, explore effective ways and means for the standardized withdrawal of state-owned equity shares, give full play to the advantages of limited partnership enterprises, and help state-owned enterprises to innovate and develop. The typical case is Maotai bonds in December 2019 and December 2020. Maotai Group announced the free transfer of 100 million shares of listed companies accounting for 8% of the total capital stock of Maotai, with the market value of about 160 billion yuan based on the market price at that time to Guizhou state-owned assets. At the current key stage of China's economic transformation, it is particularly important to maintain the credit of local governments and prevent regional financial risks. Therefore, the faith of urban investment bonds still needs to be maintained before urban investment companies have completely decoupled from government departments.